Let's understand the difference between Dscr and Foir. At first, let us understand why these ratios are calculated. Both ratios are calculated to measure the repayment capacity of the borrower when they approach for a long-term loan. Here, Dscr stands for debt service coverage ratio and FOIR stands for fixed obligation income ratio. At first, let us understand each of these ratios in detail. Dscr. This ratio is calculated like this. Cash available for servicing the loan in a year is divided by annual loan repayment obligation. So when I say cash available for servicing the loan, it is calculated as profit after tax added by depreciation added by interest on term loan. Here we are adding back depreciation because it is a non-cash item. We are adding back interest on term loan because we are interested in knowing what is the profit available before paying this interest so that it can be compared with the interest. Okay. And when I say annual loan repayment, it is basically interest on term loan repayable in that particular year and annual principal repayment. So in Dscr, basically we will be comparing the cash profits available with the repayment obligation. Let's take an example. Here, let us find out cash available for servicing the loan. Already I gave you the formula and here you have the respective values. Profit after tax, let's say 40 million. Depreciation is 15 million. Interest on term loan is 10 million. And when I say interest on term loan, it is basically interest on old term loans as well as the proposed new term loan put together. So if you add all this, you are going to get 65. And we will call it as cash available for servicing the loan. I am doing this for 1 year. Like this, it will be calculated for each and every year for the term loan period. Next, let us also calculate what is the annual loan repayment, which is basically sum of interest on term loan, that is both existing and proposed, plus annual principal repayment. Here already we know what is the interest on term loan, which is 10. Annual principal repayment, I am giving you the information 35. So 10 plus 35, you get annual loan repayment as 45. Now we have to compare these two. So let us do that. Cash available for servicing the loan is 65 and annual loan repayment is 45. So 65 divided by 45, you get value as 1.44. So this means this entity is having a cash profit of 1 rupee 44 paise for every 1 rupee of loan repayment obligation. It means they have 44 paise in surplus. That is 1 rupee 44 is the cash profit available, of which 1 rupee will be used for repayment and they are still left with 44 paise surplus, and this surplus can be used by the entity for supporting the business. So basically it will go for working capital and it can also be used for paying returns to the owners in the form of dividends. So that's about Dscr. Now let us also understand Foir. Foir stands for fixed obligation income ratio. As the name says, fixed obligation comes in the numerator and income comes in the denominator. This fixed obligation is going to be sum of existing EMI and proposed EMI. And income is basically profit after tax added back by depreciation added back by interest on loan. And this formula is mostly applicable for borrowers who are business entities. In case of individuals and all, this income will be basically income reported as per income tax returns. Let's assume some numbers. Let's say a borrower is already having an existing EMI of 5 lakh and he is proposing a loan which is going to involve a new EMI of 3 lakhs. And this borrower is having an income of 10 lakhs, which is basically sum of all the 3 items. So fixed obligation is 5 plus 3, 8 lakhs. Let us capture that here, 8 lakhs. Income is 10 lakhs. So 8 lakh divided by 10 lakh gives you 0.8, and when you express that in percentage, it is going to be 80%. It means 80% of the income is going towards fixed obligation, which is very high, because after 80%, this borrower is only left with 20% of income for other purposes, and that will put lot of strain on this borrower. Banks will prefer borrowers with lower FOIR ratio. So having understood some basics of DSCR and FOIR, it's time for us to understand the differences. Yeah, look at here. DSCR is mainly calculated for term loans. Term loans are the loans which involves creating an asset out of the loan. So it is generally considered or given for projects. There will be creation of some asset out of the term loan, which may be machinery, which may be land and building, or critical assets for the entity. Whereas FOIR is basically calculated for mortgage loans, retail loans and all. So here there may be or may not be any asset creation. DSCR is calculated based on projected cash flows. Yes, if a borrower is going for term loan, let's say they are asking term loan for 8 years. So in this 8 years period, what is going to be the cash generated by the borrower? That will be considered as a base, and that will be compared with the obligations, and then DSCR will be calculated. So it is purely based on projected cash flows. So it is like building castle in the air. So even a company which had zero cash flows in the past can still go for a term loan and DSCR can be calculated. Whereas FOIR is purely based on past declared income. Here the bank will be studying what was the past declared income of the borrower, let's say for the past 3 years, with more focus on the immediate last year. So these income will be taken as base, and that will be extrapolated for the future. Maybe that will be freezed at the same level without a significant increase. Let's say for example, in the past 3 years, the average income is 100 lakhs. That is, average income for the analysis purpose is 100 lakhs. Then for the future also, it will be considered as 100 lakhs only. And with this, whether the borrower will be able to repay the loan or not, that will be measured in FOIR. But that is not the case with DSCR. As I told you, even if the entity had zero income or cash flows in the past, still they can project a higher cash flow in the future and DSCR can be calculated. So it all depends on the viability of the project. The focus is on viability. Number 3, DSCR calculation is generally applicable for term loans, and most commonly they'll be high ticket loans, and you will see them in SME and corporate cases. Whereas FOIR, as already I said, calculated on mortgage loan, retail loan products, so their size will be small to medium ticket. Number 4, higher the DSCR ratio, it is considered as better. Most banks will be insisting on a minimum DSCR ratio of 1.50. Whereas for FOIR, lower the ratio, better it is. If the ratio is below 50%, bankers will be more comfortable. So that's about the difference between DSCR and FOIR. So thanks for watching this video. If you like this, then do not forget to follow, comment and share. And here we go. Credit and Financial Analysis Mastery course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1-year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.